What sectors are starting to outperform? The answer might surprise you. The most effective way to play quadruple witching. The S&P and NASDAQ both hit all-time highs while people call for a crash. US dollar versus the yen hits a multi-decade high. Should we be concerned? Short answer, no. NVDA drops 10%. Did we miss the move? XLK rebalancing and how to profit from it. Semiconductor index makes another all-time high. Advanced topic of theta and how to use it to your advantage. Largest weekly inflow ever to tech funds. We're going to discuss how people are reading this wrong. The inverted yield curve is making the rounds again. Why every trader should just simply ignore it. NASDAQ new highs versus new lows over a 52-week period is back to trough levels. We will show how this plays out in the past. This video is packed. Let's get to it. Hey everybody, welcome back. Well, we have a lot to go over. We're going to jump right into it. There's a lot of things I'm supposed to be afraid of, and I'm going to explain how you should actually view the data. Specifically, there's three big misnomers about tech coming in and this huge tech inflow and what it means, meaning it's a top. We have some other things going on here that are just kind of silly when they're talking about the breadth. I think they're looking at it the wrong way. And we really should be scared, apparently, of Japan and what's going on there with the US dollar. We're going to cover those three things in detail and then look at what stocks are actually doing and make more informed decisions. So we're just going to start with the S&P 500. We're going to start here with the futures market, the weekly, and just look at the basics. And I think that's the best place for us to start. I'm going to drop a couple lines just to start with so you can see where we're at. Number one, you can see the break, the retest of the break, the rally, and then the break back down. And so you just mark these levels off to watch them. And then we could just put one up here for now. Now that's going to give us four areas of interest. And what we're seeing is the break, the retest, the go. The break, the retest, the go. So now you're boxed in up here. And what is this telling us? It's telling us we went higher. It's telling us that we made another higher high. But apparently there's a lot of things that we're supposed to be afraid of. So let's go through this and see if we're afraid and if we should be afraid or not. So do we like this? Do we like that we have this gravestone at the top of the chart? Not particularly, but let's mark off these areas and see. We have a battle here. We flipped. We broke down right here again. And what happened? We flipped. We tested this level and flipped. All we're doing is working it off and then backfilling and going higher. Now, the things that we're supposed to be worried about, we'll get to in a second, but let's just deal with this. This is all we have. So are we concerned about this? Well, you went through quad witching, which was today at the time of filming this, and we all lived. Okay, should this bother us? Maybe all we have to do is just look at this data and then kind of go from there. In other words, let's just see what happens instead of telling the market what it's going to do. But I saw three pieces of information out there that are just floating around. And the way that people are looking at this data, in my opinion, is wrong. There's a really good book on this I'll point out in a little bit. But if I look at this, what do I have? I have a gravestone. Okay, let's say I make a lower low. That would put me at 19,904. All right, so maybe I come back and I retest this level. Well, what does that do for me? Okay, that would be a 5% correction. So what? If it does happen, it would actually be a good thing. We'd be able to buy stocks cheaper. So is that the end of the world? I don't think it is the end of the world. Now let's go take a look at some other things. If we take a look at TNX, what's the bond market doing? Bond market's dropping. Okay, so the bond market continues to drop, which means they are what? Buying bonds, which means the equity risk premium, for those that don't know, the cheaper bonds get, the better equities are as long as earnings are in line. Meaning as long as earnings are staying constant, if bonds are bought, people go and buy equities. It's called the equity risk premium. We've gone over it a couple times in this channel. We're not going to go over it today. Just look up the thing if you are not familiar with it. Equity risk premium. Look up the thing. I'll stick with that. I'm not editing this. So what do I mean by that? You realize that things get cheaper. How about the dollar? We're supposed to be concerned about the dollar. As the dollar goes higher, equities are supposed to sell off. Well, someone needs to tell the equity market because here you are, December 26th, and the dollar's gone higher. Should you be concerned? Apparently not. Apparently, if you followed this logic and you watched the dollar go higher, you would have not bought equities since January. How'd that work out for you? Not very well. So we have the dollar going higher, and that's supposed to be really bad, but equities are going higher. All right, so then we have this candle here that we're supposed to be concerned about, and the breadth of the market is horrible. And we're supposed to be concerned about the breadth because that's really bad too. Okay, we'll get to that in a moment. And then we're supposed to be concerned about this recession, and we're supposed to be concerned about the fact that the bonds are dropping. And here's the 10-year. Here's the second thing we're supposed to be concerned about with the bond market. Stay with me because we're supposed to be concerned about yields because we're at a 4.7 here on a 2-year. And we're supposed to be concerned about this 10-year being at a 4.2. And we're supposed to be concerned about this inverted yield curve. Now, what we're going to do is we're going to debunk these things one by one, but we're going to do it with actual data. And the importance of using actual data is when you understand what the data is, then you can use it to your advantage. For example, this is the 10-year Treasury constant 2 versus 10. I keep hearing that this inversion is back and we should be afraid of it. It is constant. It's on social media. Everybody's seeing it. They're talking about it again. It's a real issue. It's the same thing we've been dealing with for some time. But let's take a look at this for a minute and just go, okay, this is when we were underwater and the 2-year was greater than the 10-year, which is what we're dealing with now. Is this an area where you wanted to buy stocks? If you go look at the market in 1982, 1983, 1984, you will see this was a great time to buy equities. Go and look after the crash of 87 and go look if this was a good time to buy equities. If you take a look right here, this was probably the worst time out of all these inversions to buy equities. And you had a big peak that you came off of, but nonetheless, if you were looking at this data, this one you would, if you were basing it off of this, you'd have to say, yeah, this wasn't ideal and the market sold off and you were coming off a huge tech boom. But again, Cisco was trading at 80-time forward earnings back in the day, which is much different than when people are equating it to NVDA, which is trading at 30 times next year's earnings. But we can get to that in a different video. Then you would look here and go through this 05, 06, 07 period and say, you were inverted there. Do you want to buy equities there? And go look at the market. Yeah, you did. And you had a good solid 2 years. So if you're waiting here, just for point of reference, you've been inverted since 21. Actually, if we zoom in, it started it kicked in right after 22, and you've been inverted now for a good solid 2 years. So what were you supposed to do for 2 years? You were just supposed to wait for Armageddon. You were just supposed to wait for something to happen. Meanwhile, you have stocks that are up exponentially. So the idea that this one determines whether or not you're in a recession or going into a recession, it's not accurate. It's something that people pay attention to. But if you look at anything from a statistical standpoint, please remember this. For just the basic standards, if you have something like 2 variables, you need 30 data points. You have about 4 data points. So to say that there's with statistical significance that we need to look at this and say when this happens, we're going to go into a recession, it's just not accurate. Now, as always, you are welcome to comment on there and point to anything that you would disagree with as to why it does show that or doesn't show that. And I want to be really clear. I'm not saying everything's rosy. It's not, because I always get these comments where saying, you're saying everything's rosy, it's going to go up. No, what I'm saying is the people that are fear-mongering in order to get clicks or likes that are showing you this stuff have no concept of how to use this data. And it's damaging. And it's damaging to you when you want to trade. I'm going to give you a great example of another one. In front of us is the dollar. And I look at the dollar as a secondary indicator during bond auctions. People are fully aware of this. We talk about it all the time. In these videos, the Saturday videos linked to the rest of the week. You guys know how this is going. And thank you for your comments on the educational video yesterday. We tried something different for Thursday, and it seems like it was a hit. And I appreciate the feedback. Apparently some of the dings are too loud. We'll work on it, but let's get to this. All right, so here we are, January, and we've been ripping. And so if we did something as simplistic as look at the SPY during the same period of time, has this really affected what's happening? And the answer is no. It's had no effect whatsoever on what the S&P is doing. That is irrefutable. No matter what anybody says, no matter what fear-mongering is going on right now, it's done nothing. Well, that's because you're not comparing it to the exact, the yen. Okay, let's go down that rabbit hole. So yesterday's fear was this. Yen 6-day decline highlights risk of Japanese intervention. Okay, Japan's going to intervene. We'll take appropriate measures if needed. Currency nears weakest level this year versus the dollar. And you can see right down here, June 20th, and this comes out at 12:43. And then we saw a little bit of panic in the market yesterday, didn't we? A matter of fact, if we go and take a look at it, we had this huge drop and we couldn't just figure out why it was happening, looking for data. But apparently the new fear is that, oh, they're going to intervene. Japan's going to intervene. And this is going to be an issue because the yen and how it's all tied together. And this is going to be a problem for us. So here we have July, and this is 2023. Intervention to shore up the yen will not work. This was July 11th, 2023. You can see the time right down here. And the fear-mongering went on for at least a month. It actually went on longer than that. You can see down here, yen slide towards intervention zone. They're going to intervene. Now, some of you will remember that we actually did a video on this about a year ago. And this is that area where it completely collapsed. Now, conveniently, when it dropped the market, it provided a huge opportunity for the rate cuts or when the rate hikes were going to stop. But We're not here to put our tinfoil hat on. What we're here to do is just talk about the fact that they've been talking about this intervention for some time. So it must be something new, and there must be something new going on with the dollar versus the yen. And then we look at the US dollar versus the yen and realize it's been going up all year long. So whether or not it's over this level that apparently didn't really matter, that we flipped back here in March, rallied up, didn't really affect the market, pulled back, really didn't affect equities, and now we have a new high. But apparently this time it's going to affect equities. And where am I going with this? You need to understand these things and how they're connected. From my perspective, just trade what's in front of you and trade what's going on. This is not something, unless they have a major issue where they're going to sell $1 trillion worth of US debt, this is not going to affect us the way that people are making it out to affect us. There was a time where it could have, but clearly that time has passed. Again, the significance of the two misnomers that we just carried are this. People will put stuff out there and they'll make news. Your job is to analyze the data, not just accept it at face value. And we've seen a lot of this. I can give you examples where we've seen it in the news about names, where names were completely set up to shake you out, and then they shake you out of the name, and then they rip the name higher based upon news. They can do the same thing with the market. You know, there is that greater fool theory where they're just trying to shake the tree and see what will happen. But if this was going to be an issue, why today? Why on Friday is it an issue? Why hasn't it been an issue all year? Now, someone will comment below and tell me I don't understand. I don't think they understand that this is the same exact level that you've been at, and it's done absolutely nothing. We've been hearing about this intervention for about a year now, and nothing's changed. Now, all these misnomers, I would just tell you this. I personally think they're reading them wrong. And by reading them wrong is, I think if you have an inverted yield curve, I think that suits very well for the market. I think if you go back and look at the yield curve and you mark off the S&P when you did invert, if you looked at buying the equities then and you bought the equity market, you did quite well. I would also go to look at the Japanese intervention talk and watch what's going on there and say if you bought equities on those dips, you did quite well. And this is another one where they're pointing out and floating this out there today that, oh, this is clearly going to mark a level. And this level is a huge concern because there's tech flows are the largest ever in tech funds. And so we're going to put a couple things out that's wrong with this graph. And I'm pointing this one out because it's out there. And I think this data is pointing to something completely different, and I'll get to it. But if you look at the largest inflows ever in tech funds, is it really? Because the graph says it is, right? So it must be true. Okay, well, there's a little line right here, and it shows 4 weeks moving average. And so before we even begin, we're just going to point this out. Here's the 4-week moving average. Now, you have nothing invested during these weeks, and then you have this huge line right here, right? So let's take this 4-week average that can't be as manipulated, and let's just come across and drop that line right there. And then we would look and realize that the graph only goes back about 8 years. Maybe that's as long as they've been taking it. And then we would look at the levels and go, okay, well, here's the beginning of 21, and here's the beginning, okay? And then we would look at these dates. So let's take a look at these dates. Now, on this graph, for time's sake, I have marked off 5 very specific dates. The top 4 dates are in white. I marked the 5th or 6th highest just so you could see what could happen. And I think it's really important just to point it out. I don't think this is where you're at, but this is one of the top 6 or 7. This is 1, 2, 3, and 4, and this is roughly 5 or 6. Do these look like areas where we should be panicked because we're seeing massive tech flows into the market? And the answer is no. So again, it's really important. I'm going to tie it in together because to me, the new highs, new lows that they keep going over is just even more baffling. But when you tie this together, is this something that I should be concerned about? No, they're throwing money into the market and they're buying names. A matter of fact, even on quad witching today, which when we start going through individual names and you see the bounce, it was pretty substantial. And we're going to get to that. But this is another complete misnomer that when you tear it apart, these are areas where you'd actually want to get involved. Now, does this play out the same way? We don't know, but we do know one thing. This graph is completely misleading. And it's misleading because what they're doing is they're marking off here with this 4-week weekly flow number being up here. But if you take a look at the 4 weeks after and you marked it off that way, it's telling you very clearly that you've been here before at least 3 times. And these times worked out very well for the market. Let's take a look at the new highs, new lows on the NASDAQ and wrap this thing up. Now, I'm a big believer in looking at the data and then interpreting the data. And what I mean by that is by looking at the data, interpreting the data, you might get a different opinion. You might even get a different opinion than I'm going to get from interpreting the data. That's why it's so important for you to learn what you're looking at and then go from there. So I will start putting these out there. If you want to follow me on TradingView, it's Arete 20706. And I'm going to start putting some of these out there and figuring out how to tie them into scripts. But this in front of you is relatively simple. And I'm not going to go back all the way. This will go back pretty far. We can squeeze this down and then I'll tell you what it is. But you can see just how far back this is going to go and the anomalies. What you're looking at is 52-week highs versus 52-week lows on the NASDAQ. And what's important about this is a couple things. I turn it into a ratio. I like looking at relative performance. And one of the things we keep hearing about all the time is there's such little relative performance that this possibly cannot go on. I agree with that, but I think they're looking at it the wrong way, meaning the breadth is so low that this possibly can't stay higher. What's going to happen when the breadth changes? So the idea that no one's ever going to buy any names and these names are just going to stay down is kind of silly. So here's how I would look at this so we can just wrap our heads around it. Again, 52-week highs versus 52-week lows. And you're going to see a peak right here. And that peak's going to take you into December 28th. And then you just come here and you draw this line down and you can see our negative divergence. So what, again, we're looking at is the ratio of 52-week highs, 52-week lows, and then they're just very simply divided. And what we're looking at here, and you might want to watch this part a couple times so that you get the concept, because then you might look at the data and go, well, this is how I feel about it. And that's fine. You can also look at this data and take it apart and just look at the highs and the lows and come up with something else. To me, relative makes more sense, but more on that later. So if we just look at this, right, we would just say, oh, well, we're hitting less and less and less highs. So that's the first thing that we would say in looking at this piece of data, right? So clearly we're going to correct. Now, this is what you need to wrap your head around when we talk about breadth and different indicators with breadth. Let's take a look at the NASDAQ. This is the mark of peak breadth. This is the mark of where we are now trough breadth according to 52-week highs and new lows. Does this look like an indicator that you would want to use in order to make an informed decision about whether or not you're going to buy stocks in the market? I would argue that the way that people are using this indicator, that they are using it wrong. In other words, if you're saying, oh, there's less new highs than new lows, therefore I shouldn't buy stocks, how'd that work out for you? If you followed that indicator, you can see right here, you missed 16% on the market. Now, why is this important? It's important to me because the indicator has value. The way that people are using the indicator, or either part of the indicator, I think they're using it wrong. Let me explain. Now, on the graph, I have marked off 6 very specific dates, and I'm going to tell you how I arrived at those dates. Those dates tie and correlate very clearly to where we're at right now. And I'm just going to come here, I'm just going to drop a line so that you can say it. And you'll see how we're in here. And again, I could mark this one off as well, which would be August 21st if we wanted to, but we're going to get to it here anyway. But we can always come and look at that secondary indicator. But what I'm trying to do is I'm trying to show you something. I think that the way to look at the new highs, new lows list and looking at it on a relative basis is to utilize this list very simply as an indicator of when we're exhausted, when we're washed out. And I know people are going to say, well, we can't clearly be washed out now. And that's not what I'm suggesting. What I'm suggesting is the way that they're using this data to say don't buy because the breadth is poor is inaccurate. By using this, you can determine when to get back in here. You're going to be able to see in here, in my opinion, pretty darn clearly how if you were looking at this off these little marks, that when you start to see a little bit of movement moving higher, you're going to be able to figure out and go, you know what, I need to take a look at this. This is getting interesting. So you do want to look at the data and you do want it to go in the right direction, but to look at the data washed out, and you'll see what I mean in a second. Let me show you these exact dates that I just marked off, which sit at these trough levels. And let's take a look at them on the NASDAQ. Now, what I've done is I've taken the same exact level of dividing the 52-week high divided by the 52-week low of the NASDAQ. Again, all I've done is divide the 52-week high by the 52-week low, create a ratio out of it. And what I'm showing you is that to me, it shows exhaustion more than anything else. And if I take a look right here, if you just looked and said 30 days later, am I higher? The answer is yes. Again, 30 days later, am I higher? Over and over and over again, you are. Now, maybe this one caught you, but then you just got another signal here again after this signal. So maybe you could say, oh, it doesn't work, or maybe it's giving you a signal to tell you there's going to have another one later. We can get into all the nuance of this. What I'm saying is the idea that we're going to use this data in here and suggest that this data is going to tell us whether or not we should be in the market or out of the market, number one, is just a fool's errand and doesn't make any sense for us to do that. That is the first thing you should take from that. And based upon your comments, People will say, well, what are you getting at? And of course, I think it's abundantly clear, but I get why it's not. And maybe this is a little bit of an advanced concept, so let's get into it. What I would suggest is that we should monitor this. And by monitor this, we can actually even take it apart and look at the pieces of it in a second. But really, I like looking at the relative basis of this. Because when I look at this, if the minute that this ratio turns, I want the ratio to turn. I just don't want one piece to go up or down. But when this ratio starts turning, that's actually a trough valuation, and we're at that level. Now, does that mean because you're at that level that we should get involved? Not necessarily, because we hit this level before down here, and then it lasted like this for a couple weeks, and we went sideways. You could argue you went for a couple weeks in December before it triggered, or you could say that, okay, you waited a couple weeks here, maybe a week or two there before it triggered, right? So you could make that argument, sure. But if you look at this data, this is certainly not something you use to say to not get in the market, that we're making more new 52-week lows than 52-week highs, and it's the worst it's ever been. See, this is the important thing about this kind of stuff. And when you actually understand what the data is, there's a really good book on this that I have talked about a couple times. And I'm always asked, like, what books kind of change the way that you view the market? This is one of them. It's not an easy read, but what this guy did was he started taking apart numbers that people would look at, whether it was consumer sentiment or indicators that people were using, and he tore them apart. And he would look at them and go, the way that they're being used is different. So what I got out of this book, and what you would probably get out of this book, are how he looks at things and then what happens from those dates. One of the glaring ones that's in the book is he talks about people think that rate cuts are bad, and he goes out and charts how to profit from things like that. It's fascinating. But what this book did for me was it allowed me to learn how to think differently about the data and understand what the data truly represent. And it's a great read. It really is, if you're interested in understanding the data and making a more informed decision. But real quick, we'll take these two pieces apart. And what this also will do is it will explain very clearly why this is important to use as a ratio. For example, this is the 52-week new highs on the NASDAQ. Well, you're not at new lows. You're here, right? That would be new lows for the 52-week high list. You're nowhere near there. And this also correlates right where we just rallied from as well. And then here as well. But what's important about this is you would look at this and just go, oh, well, we're hitting new highs, so clearly we have to get involved. And if you go look at the chart, couldn't be a worse time unless you were just day trading. And we talked about this correlation in the drop and why that's so insignificant to use. As a matter of fact, it would have kept you out of the market from January on. So understanding these breadth indicators and how to use them effectively is important. If we took a look at MALQ, MALQ is going to be the 52-week lows, and go, oh, we're hitting 52-week lows. Well, if you take this piece of data, you're nowhere near the 52-week lows you were just hitting a month ago or 2 months ago, or even the ones you were hitting in November. You're not even close. So what this is actually showing us is why we need to use the ratio, because the ratio is telling you that you're at the same exact level that you were at previously. And we could see that right here, right? We can see why the ratio is so important versus just using it like this. And I think this is a very important concept, because people say, well, why would you use the ratio? Why wouldn't you just use these two pieces? Because this is not as extreme here, and this certainly is not as extreme even as it was 2 months ago. But when you look at the ratio, you're going, oh, we're back to here again. And that's why you want the ratio. But what would we want to see? Of course, if we start getting over, you're going to want to pay attention to that. And if you start getting over here as well. But this, again, is why we use a ratio. And to me, this ratio is suggesting you're pretty washed out. And for how long we're washed out, I'm talking about the breadth being washed out. And as far as the breadth being washed out, there's not really much further to go in regards to that. Now, should one part of it be at extremes like this, then I would say, no, that makes sense. Yes, we could go lower, but that's not the case. Please comment on this. If you have questions about it, I'm more than happy to go over it again. Your comments are why I'm doing this, because we're at a crossroads right now, and we are seeing signs of a crack, obviously, and we want to discuss that. 4 times a year, you're given a gift. That gift is quadruple witching. We're going to explain exactly what it is and how to benefit from it. This is going to be advanced. There are parts of these videos that are basic. There are parts that are advanced. The next 5 minutes of this is going to be focused solely on 5 or 10 minutes, solely on options. If that's not of interest to you, you might want to fast forward. But this is something that people would probably put into some kind of options class and charge you like $1,000 for. I'm going to go over it in 5-10 minutes and save you hours. I'm going to save you about probably a grand or two. Quadruple witching. You have quadruple witching. It's not really quadruple witching anymore. I'm very old. I'm a boomer. I'm in my 40s, so I still call it that. They got rid of the single stock future, and they got rid of it years ago. But we still say quadruple witching because it's cooler than saying triple witching. But Quadruple witching refers to simultaneously expiration of 4 times a year stock options, index futures, and index future option derivative contracts. The fourth type contract involved single stock futures. They're not around. They haven't been around since 2020. Now, triple witching, why is this so important? You have all these asset classes, and now you say 4 asset classes, but as you can see, one stop trading. You have all these asset classes, and what they're doing is they are competing. They are competing to execute at the best possible price. So what happens is that competition will have them trade up, then down, and then what will happen from here is you'll get tighter and tighter and tighter as the day goes on. This is a really good thing, and you can profit from it. Now, we will be reviewing stocks right after this and which ones you should be looking at, but what I want to do is explain to you how to utilize this, and you'll be able to see this for what it is. If you have a chart, any day, in this case, you gap down on NVIDIA, up or down, doesn't matter how it plays out. Usually they gap them down on quad witching, but it doesn't matter. But what happens is as the day goes on, this will get tighter and tighter. And the advantage of us understanding that is that we can just take advantage of it. So you'll see these rallies, and then those rallies will lead to nothing. And people will think that they're going to break out, but they're not going to break out. It usually happens at the end of the day, and it did not happen this day. Then you break down, and clearly we're going to go lower, but it doesn't happen. And then we rebound. And they think that we're going to go higher, and then we come back and retest, and then we break out, and clearly at this point we're going to break out and we're just going to continue to run. But that's not what happens. Then you drop back down, and then we just go sideways, and the cycle is complete, and everybody that bought calls or puts in here got absolutely destroyed, and they can't figure out why. Now, before we go further, I want to explain a couple things. Quadruple witching, or some people are going to say triple witching, and I get it, but I'm old, so I'm going to say quadruple witching. A couple key things here. This is an excellent day to see where money is going. That is the first thing you should take away from this. You are given this gift 4 times a year. You had $5 trillion expire. $5 trillion. And we're going to go through the names and where I think it's going and what's going on. So understand that $5 trillion expire, and they had to reset and move that money around on Friday. So that tells you the first thing where it's going. On the option side, the way to play this is to either do credit spreads. Some people refer to what I'm about to show you as a straddle. I don't care what you call it. People have fancy names for them. There are several different kinds of spreads, as people are aware. We're not going to get into them all, but you could have a debit spread where it's going to cost you money. You could have a credit spread where you're going to bring money in. You can do this through puts. You can do this through calls. I would suggest on quadruple witching that you look at selling options and bringing in premium. Okay, that would be called credit spreads. That's not really what I tend to do on these days, and I will explain what I did and I think the way that you could benefit from this. But let's get into the actual minutia on how this plays out. Understand that every day when this happens, every quad witching, when this happens, this is what it looks like. You look like you're going to break down and you don't. You look like you're going to rally and you don't. It's an excellent day to position build and see where money is going. But if you're trying to play the day trades and you're trying to see if you're breaking out, you're going to get really frustrated on these days. A matter of fact, if you just look at the S&P from here over, you can see that you really went nowhere, and nobody should be shocked by this. But let's talk about the minutia of this and how you would benefit from this. Now, my personal favorite strategy with days like today, when we have quad witching, and this is being filmed during quad witching, my personal favorite on days like today is to sell puts when I can. I enjoy selling puts, meaning selling something I don't own. And then when I sell something I don't own, I go out there and I buy calls with the puts that I sold. I don't have to do that. I could just sell the puts and be just fine, but I like to sell the puts and get my free trade paid for and buy the calls. And I'll explain in a moment what I did. I'll show you the timestamps. I have it live. I don't know that I'll show it live for time's sake, and it's kind of boring. It's not overly exciting. You know, when you have a straight line and you're flatlining, it's not the most exciting thing to say, look, see? So I don't know we're going to get there. But there are parts to this you have to understand. So in front of you, you should be familiar if you're watching this with Greeks. If you are trading options and you do not know what Greeks are, you want to stop trading options because you're at a huge disadvantage, and then go buy a book and read about the Greeks. One of the books that I would recommend is Options as a Strategic Investment. It's really considered the Bible for options traders, and let's get into it. But again, I like showing these books because I think it's helpful for you to, instead of me saying go buy a book, here's the book. Lately, I think I've been kind of cranky or more irritated with some of the stuff I see out there. I don't know. Maybe I am becoming a boomer, but you can always comment on that if I'm getting more cranky. I don't think I am. It just feels that way lately. Maybe I'm just sick of the nonsense lately. I don't know. It just feels that way, but let's get to it. So you should have a basic understanding if you're watching this. People do say that I should point out why you're even listening to me. If you're watching these videos, you should have a clue, hopefully, that I know what I'm talking about. I've been trading 25 years. Last year, I won the US Investing Championship, and not that little piker division where you're just doing stocks, the division where you're doing stocks, options, and futures, and I think I'm in the top 2 or 3 in it this year. I do it because it's fun, but you really should be getting value out of anything that you're watching. So whether or not someone has anything like that, you should really just focus on what you're gaining out of the video. In other words, you do want to look at it and go, well, who is this guy? Why should I listen to him? I've been trading 25 years. I used to work at some of the top investment banks in the world. I was a registered options principal at one of them for 9 years. I understand this stuff intimately. But if you don't relate to me and you don't get value out of the information, you get value out of somebody else, then you should watch that person. It's not just the information that's presented to you, it's if you're getting value out of that. And I think that's really important for people to get. Like, some people just could care less about what I'm going over, and that's okay. You really don't have to care about this. But this is an edge. And a lot of people miss this edge because it takes a lot of time to kind of wrap your noodle around. So let's get to it. Now, NVDA, and it could be any option chain, but these are the Greeks. And if you don't know what we're talking about, get that book, read it, timestamp this so you understand what the Greeks are, and then come back and watch this. That's the best way that I could explain it. Delta is just going to tell us how much that position is going to move per dollar of unit, okay? Think of this as like gas or the speed of a car, right? So in other words, if the speed of the car is going 50 miles an hour, think of it that way, because I'm going to show you something else in a moment that's going to be really important. If your car is going 40 or 50 miles an hour, and let's just say it's going 45 miles an hour, and let's say that the car all of a sudden goes to 50 miles an hour, the difference between the speed, right? So I want you to think about that for a second. The difference between the speed, if you were going from 40 to 50, that's gamma, all right? And that's going to play an important part here. I'm not going to, and for all intents and purposes, I'm not getting into rho, and I'm not going to get into vega, but I just want to give you the basics of it. Theta, time decay. How much am I going to lose in a day? Am I going to lose a lot of money, or am I going to lose a little money? Now, this is a really important thing, and theta, because it's called theta decay. This is how much you're going to lose in a day. So let me give you an example of this. Here's January 28th. We're going to go on the assumption that all things are equal. And if I go to theta here, I can see on the 130s right here that I'm going to lose 23 cents. That means if everything stayed equal, I'm going to lose 23 cents a day. And that would mean on 5 days, I'm going to lose $1.25 on that option. You'll note that I don't have option prices on here. All we're doing is just talking about the Greeks. So what does that mean? That means if everything's equal, I'm going to lose $1.25. So, and the curvature is not what you think. It's not equal. It's not this. The curvature is more like this, right? We know this. And then it just starts leveling off, right? It's more of a curve, and that's what people never really get. But we'll get to that because there's also an inverse curve. But let's stay focused. So if we take the 130s right here, for example, and we understand that delta is going to be negative for puts, right? And then over here, if you look at delta, you're going to be positive. It's just the way that it is, okay? And it doesn't matter because it's all where the stock is, and that's why they're different. So I'm just taking the 130s because it's easy. If we go and take a look at that in the theta, and then you look at the implied volatility, if you have something and you know that something is going to go like this, up, and then they're going to tie it down, and they're going to arbitrage it all day long, right? And that's what they're going to do on quad witching. Now, when they do that, what's happening here? Time's going away, all right? Time is going to go away. Not only is time going to go away, but the delta is going to increase, right, at first, and then what's it going to do? It's going to decrease. So the delta is going to increase off the open, up or down. It just is, because you're going to get wild movements off the open. And then what's it going to do? Then it's going to decrease. That delta is going to decrease over time. And then what else is going to happen over time? The gamma, when that spikes up or down, when it gets near the at the money, that's when gamma is the most. For example, if I bought or I sold puts and I bought calls on the video, and I'll show you the trade in a second, but we're in a couple minutes. But if I take a look at out the money, at the money, in the money, you should know what these concepts are. You know, out of the money means exactly that. Your option is not in the money. If you bought 130 calls and the stock is at 129, you're out of the money. If the stock's at 130 and your option's at 130, congratulations, you're at the money. If you're in the money, okay, that means you're at 131, 132, and your call is at 130. All right? Okay, good. So what this means is when is gamma the most? When is speed plus speed the most? When you're at the money. Okay, when is gamma increasing? When you're out of the money and you're going into the money. So if you know that, when are you going to have the most gamma. Okay, when that option that was out of the money goes to in the money, speed on speed increase in delta. When do you want to sell your options? When they're at the money. Okay, that's when you want to sell your options on quad witching. Please rewind that part and listen to that again. Not when they're in the money and the day goes on and the theta decay kicks in. That's not when you're getting out, because you're smart and you watch this video. And you didn't even have to pay for this. I sound a little cranky. So like what you're seeing here is at the money. That's when you want to get out, okay? At the money. You don't want to wait and see what the options are going to do. You can if you paid for them. And that's a strategy that I do, and I'll walk you through it, because you can make more money if the delta increases, and we'll get to that. But if I'm out there and I want to sell an option and I'm long, especially on quad witching, if you're long an option and you get that side of the option, you want to sell when? At the money. You're never going to get a better price. It's just not going to happen. Now that I've drilled into you that the best time to sell is at the money, and that is something that you can go and look up. You can go look at that on the CME website. CME actually has a really good website explaining options. Understand this, that during quad witching, as we're getting tighter and tighter, the delta is going to decrease, meaning the speed is going to decrease, okay? Because you're not going to pay the same amount as the day goes on for something. Therefore, delta is going to decrease. Gamma, the speed of the speed, where are you going? You're not going anywhere anymore, right? So the speed of the speed is not going to increase, it's going to decrease. And then we're not going to talk about rho, and we're not going to talk about vega today, because that's the time. I'm not going to get into it. So, and then you have the decrease of the theta, which you can just calculate and go, well, no matter what, I'm going to lose this amount today. And then of course the IV on all this is going to decrease, which is going to decrease your option. Why? Why is that going to happen? Because you're going to do this, and then no one's going to want to be in something that's doing this, right? So the implied volatility is going to decrease. So all this is going to decrease, and all of this is going to put money into your pocket. You can do this through credit spreads if you understand those. By you buy the 130s and then you're selling the 135s if you want to do debit spreads, or you can buy the 130s and then you're selling the 129s. There's all kinds of calculations you can do where you're doing debit spreads, credit spreads, calls, puts. This, for me, the most optimal way to do this is credit spreads and what I do. Now, these are the next dates for 2024, 2025, where you will have quad witching, or what the cool kids now call triple witching, because that's really what it is. But I'm very, very old, so I'm going to call it quad. And you can see these right here and where the next time's available that this is going to happen. I hope you found this helpful. You might want to just earmark this and watch it. If you're interested in this, please let me know. I will do more videos like this. This is pretty advanced, I get it, and that's why I prefaced it with it. We'll go and we'll start looking at some charts now. So what I want to do is just very quickly walk through this trade so you can see it live. I'll show the timestamps as well. But what you're going to see right here, this is where we sold the puts. This is where we covered the puts back. Now, I got very fortunate with this trade. Pretty much nailing the bottom. I mean, really what I was watching was just the gap fill. This is the inverse gap fill. You'll see it on the stock in a moment, but I just think it's important to see it live. And I'm not scaling out of these. I'm locking it in, right? I'm just locking everything in and going from there. And the other side that I'm not going to get into is I bought calls with the money, right? So for everything I did was 10 to 1. So if I sold 10, I bought 100 calls. It's just how I want to play it. You don't have to do that on these days, but I did think that we had the potential of a gap fill, and I'll show you those timestamps in a second. I'll do a quick recap here. One of the big misnomers out there for me is always win rate. I just think it's really important to kind of really hammer this home. People always talk about this 80, 90% win rate. It's gobbledygook, if that's a word. I'm at 53.96 on the year, and you can see that right here. And I think I know what I'm doing. I'm at 54%. Win-loss is 143. Everything's skewed. Profit factor 168. I'll show you why it's skewed in a moment. But again, this is trade expectancy, what I'm expecting to make. This account, people always ask what you start with. This started at $1.60. I think the year before, it started at 34. It was the account. This is the account that I link in the Alpha Chasers community. We'll probably reset it. Actually, we will reset it to a lower number. We'll pick out what that number is going to be in the community. But you can see right here, this was the NVDA split, and it's throwing the account off by the profit off by 100K. Now, I think it's always important to look at where you're at and what's going on. And I want to show this. And I think it's important. I was just going through this. I really wasn't going to get into all this, but I think it's important. The skew has changed, and we've been talking about the skew. We're going to go through that in a second, how you can benefit from it. But look at the trade expectancy, all right, and the win rate. I'm under 50% right now. That means less than half of what I think is going to happen is actually happening. And why this is because the stops are getting wild, right? So I'm going to get stopped out way more and more. You're noticing that. You should be noticing on your trades you're getting stopped out way more. But look at the win rate when I'm right. Okay, so all I have to do is just start figuring out how to get this 1 or 2% more, and this becomes like a monster. And that's really simple to do. You just start tweaking things a little bit. Also, quad witching set me off a little bit, just because I took a lot of positions on Friday that actually I'm building, and I'm going to get into why I'm doing that right here. But let's go through a couple other things. I just think it's important to point this out because everyone seems to think you need to be at this huge number, and that's just not the case, not even remotely. But let's get into some more of this. So full disclosure, what you're going to see in front of you is just me doing the actual trade. This is me doing the NVDA trade, and this is just me actually buying the puts. You can see that I'm selling the puts right here rather, and I'm doing it. Really what I'm starting to realize is like, okay, I got to get this off. And this was like 9:52 when I decided to start doing it. I just thought it made a lot of sense. And you can just see from the option how it played out. But you saw also how the option actually sold down more than here, right? Because of how fast it moved. We just went through gamma, theta, all of that. And you can see how that actually played out. And really what I had to do was into it to get even an optimal price, right? I got in the 4s, the 5s were possible. We're always trying to get better. I've been doing this 25 years. I'm still trying to get better. And then this is the gap fill. That was my target where I was going for up here and then going from here. And then you can see I'm closing the puts. And I had the 130 calls on that I used that money to pay for, and I paid 40 cents for 10 to 1 on them. And they traded up. I mean, they were like at $1. They were over 100% at one point in the day. If you want to take it, you could take it or you could hold it. Sometimes I'll just do that to pull money out and then just see if I hit a home run later in the day. It doesn't cost me anything. Just want you to know what you're doing. But this is a really good strategy for quad witching. And I can't express that enough. And as the cool kids say now, triple witching. But again, I like showing the timestamps. Someone gave me a great compliment the other day. They're like, what we really care about is your street cred. And nobody has more street cred than me. So that it made me feel warm and fuzzy. So I appreciate that. And the more that I can show so that you guys can figure out how to do this stuff yourself, just drop it in the comments and I'll just keep it coming. Let's get to it. Okay, now that we've gotten all warm and fuzzy and shared our feelings, let's talk about what's really going on out there. This is a control bar, and this is a concern. And what people will say to me is, you're bullish. No, I'm not bullish nor bearish. I'm just green. I just want to know how I'm going to make money. That's really it. I don't really care about anything else. Up, down, sideways. It's completely irrelevant to me. I would prefer the market to go up because that means the economy is better and therefore people have jobs and have money. It's just being a human. But the market is the market. There's no socioeconomic value to the market in trading 4 letters and 4 numbers. It is what it is. What you do with that money is up to you. But I think that you need to understand that I could care less what happens from a trading standpoint. But that's a control bar, and they exist, and you're staring at one. Now, does that mean that you don't buy NVIDIA? No. I bought a bunch of names on Friday, and I want to be really clear about this, as I just showed you in that P&L. The majority of them I'm scaling into, and the majority I'm down. I'm not up in those trades. On the trading side, on the day trading side, it was fine for me. On the position building side, I bought a bunch of names, and they're just very simply not working yet. And of course, they could not work. Why I'm saying this is you have to understand who you are and what kind of trader you want to be, but another video, another time. I have a doji. I have $5 trillion that came in the market, right? $5 trillion to sell. And all you're going to give me is a doji? I thought for sure we were getting, Armageddon down another big bar. I was going to be able to buy this at 122. Man plans, God laughs. I get a doji. I think that doji is extremely telling that we're not going much lower. And even if we are, they're going to give you a time where they're going to state, and it's going to be clear. We're just not going to walk in on Monday and just have this massive move down now. A matter of fact, this could even be the XLK rebalancing. What I'm looking for out of names are things like this. When I was long Apple, and be really clear about this, I was long Apple on Friday. The trade did not work. I lost money. People lose money on trades. It's no big deal. Just on to the next one, right? You're not your trade, man. People need to get that. Stop telling your ego to it. So I broke down. This actually got me going, okay, well, that's not good. 1, 2, 3. Now I've got three, you could say it's 3 black crows. And now you're going into that rebalancing. That's not what you want to see. This, closed at the low, closed at the low, closed at the low. I thought for sure you'd hold. It didn't work that way. So there are some things here that are concerning. Now, one thing that I showed in the past is a MACD histogram. And I do want to go through some names, but I'm trying to keep these videos under an hour for obvious reasons. I start to lose people. But if you look right here, right, there's a doji. But when this MACD changes colors on sectors or indexes, you need to take a break and just go, okay, are we going to go sideways? It doesn't mean you can't reverse, right? If you look at this on the weekly, there's no cracks. A matter of fact, you just flipped and you're getting stronger. And I want to point that out. That's why I went through those 4 misconceptions in the beginning of this video. The market's actually getting stronger. We just didn't feel it on Friday, and Thursday they moved ahead of Friday. Someone came out and said that, is this what normally happens? Do they usually move ahead? Maybe they do, maybe they don't. I don't know. I'm not really sure. I'm not really sure it even matters. But you see how the Q's flipping here and getting stronger? If you look at this, how many times on a weekly chart have you flipped and only gone up 2 and then rolled right back over? And it's getting stronger. So on the weekly, I don't have an issue. On the daily, we might be getting weaker for a couple days. Now, for how long, I don't know, but that's out there. So I do look at that SOXX, and I am aware of that. What I would say is that you got a doji, and I think that doji is significant. What does that mean? It means that I don't think that we need to panic on semis. I think we need to be looking at semis the other way and going, okay, I have a doji. This is what I have. I held the 12. These are the facts. These are irrefutable. If we break the doji, I have a different trade, and now I have to assess that risk versus the 22. Remember, I use a 12, a 22, and a 55. The 12, just to reiterate, what it means to me is, can I swing trade? Everything I do is top down, right? Index, well, now it's red. Sector, okay, stock. And why? That's how I trade. Is the index aligned? Is the sector aligned? Is the stock aligned? If any of those things are out, then the probability of my trade working is less per move. So in here, I could still trade this. NVIDIA, I could still trade that. I have a doji. If I break the doji, the bulls are still in charge. Remember, swing trade, bulls, is it valid swing trade? Yes or no? Are the bulls or bears in charge? 22, 55, do I have institutional support? So when I look at this and I look at NVIDIA, do I see a problem? Not yet, but that doesn't mean that that's the high, right? It could still be the high, but that's 140. I'm at 127. Everyone complained that NVIDIA, oh, I can't buy NVIDIA, it's too high. Well, you just got NVIDIA at a 10% discount in 2 days. Did you buy NVIDIA? Or did you say it's too high and I'm going to wait for it to come in lower? Did you predict this move? Did you predict that it was going to move $40? So why are you predicting that it's not going to go higher or it's not going to go lower? Maybe just trade what actually happens and build a framework around that and, give yourself some grace, man. It's people tie their egos to this stuff and it's killing them. I see it all the time, and especially newer traders do it too. But let's keep going down this rabbit hole. Okay, so then we have Micron this week. Did Micron fall out of bed? No. Can that mark the high on Micron? 100%. But if you go and look, and I bought a bunch of Micron, and I bought a bunch of calls on Micron, I'm actually up on it, the majority, not the stock so much. But I closed 11% down. I have earnings this week. Everybody's clamoring that Micron's going to crush. Now, if they don't, maybe the semis break, and maybe that's an issue. But for now, this is something that we have to pay attention to, because this could mean that we move up another level. And so that kind of got me thinking about some of these other names as well. Now, Taiwan Semi, I'm not crazy about this move. I would rather have had a doji than this, but that's on the radar too. And you have to sort them line by line. AVGO, well, that's just a disaster. I mean, that's an absolute dumpster fire, right? You closed at the low, you closed below the low. We gapped down 1, 2, 3, 3 black crows. That can keep dropping. And the devil's in the details, and I'll explain what I mean by that. You see this doji right here and how you have the 12, the 22, and the 55 on SMCI? If you take one thing away from this video, the beginners, one thing away, go on all the stocks on Friday that you're interested in and mark that hourly bar and make sure that you close on an hourly above that before you start tying yourself to anything. It's really important to look at. The winners of the day wound up holding above that. Let me show you. Here's Netflix, for example. And what you would do is go to that bar and you're just going to mark the top of it. Did you close over that? Yes, you did. And by the way, if you just take a look at Netflix, no one's really talking about this. Does this look like we're heading for a stock market crash, or does it look like we're going through rotation? Right? That's up for you to decide. This is Microsoft. Does Microsoft usually hit all-time highs in a bear market? This is IGV. Does this look like you're setting up a pendant that's about ready to break out? I would go and take a look at some of the IGV names. You can just pull up the holdings. Here's a great example of HPE that's in a multi-year base and how that's acting. And for the beginners, this is another great thing that you can take away. What you do on quad witching is you look for the rotation, because that's how institutions hide. In front of you are 39 sectors. If you went here and took a look, where are they putting their money? You have your biotechs moving, you have Bitcoin moving. You would look at these sectors and look for the rotation. And what you're going to see is it becomes pretty clear where the money's going. Cloud, XBI, BTC, FDN, IYZ. You can start going through them, IGV, and you can actually see the money moving in the end of the day. This is a really important concept. We covered a lot. If you are interested in more of those price action kind of movements that I went over with the options, but just solely with stock, I'm going to link this video at the end. It's a clip of a trade that we did live, and I walk through it literally step by step. That's it.